In 1982, the United States became a debtor nation. It happened quietly, no sirens, no emergency address from the Oval Office. Just a line in a government ledger flipping from positive to negative. For almost a century before that moment, America had been the world's banker. Other countries owed it money. Then, almost overnight, in historical terms, America began owing the world, and it never stopped. Today, the United States carries more than $34 trillion in federal debt. Household debt is above $17 trillion. The country imports more than it exports. It spends more than it taxes. It saves less than most advanced economies. And yet it is still the richest large country on earth. Its companies dominate global markets. Its currency anchors the financial system. Its stock market sets the tone for the planet. How does a nation get rich without saving? That question matters right now because the old rulebook says it shouldn't work. Every household learns the lesson early. Spend less than you earn, invest the difference. That's how wealth compounds. That's how stability is built. America ignored that rule, and somehow it scaled to understand how we need to go back to the moment the machine was built. After World War II, the United States was different from everyone else. Europe was rubble, Japan was ashes, Britain was exhausted, but America's factories were intact, its infrastructure untouched, its population young, its industrial capacity unmatched. It produced half of the world's manufactured goods. Half the dollar became the center of the Bretton Woods system. Other currencies were tied to it, and the dollar itself was tied to gold. If you had dollars, you effectively had access to the world's safest asset. That was the foundation, but the real shift came in 1971. President Nixon ended the gold standard. The dollar was no longer backed by gold. It was backed by something far more abstract, the economic and military power of the United States. This was supposed to be risky. Instead, it unlocked something extraordinary. When the dollar floated freely, it didn't collapse. It strengthened. Oil was priced in dollars. Global trade was settled in dollars. Central banks stored dollars as reserves. If you were Argentina or South Korea or Germany, you needed dollars to participate in the global economy that created demand. And demand for your currency is a very strange kind of superpower. Here's the simple version. Most countries have to earn foreign currency before they can spend it. They export goods, they attract investment, they build reserves carefully. The United States doesn't. It can issue debt in its own currency. And the world buys it. When America runs a trade deficit importing more than it exports, dollars leave the country. Those dollars don't vanish. They pile up in foreign banks and central banks. And what do those institutions do with the dollars? They buy U.S. Treasury bonds. In other words, America sends paper claims called dollars overseas in exchange for real goods, cars, electronics, oil, furniture. And those same dollars often come back home as loans to the U.S. government. It is a loop. America consumes, the world produces, the world finances America's consumption. And everyone calls it stable. This arrangement has a name economists like the exorbitant privilege. It means the United States can borrow at lower interest rates than almost anyone else because its debt is considered the safest asset on earth. Even during crises in 2008, when the global financial system nearly collapsed, a crisis that started inside the United States, investors didn't run away from U.S. treasuries. They ran toward them. The same thing happened during the pandemic in 2020. Markets panicked, capital fled emerging economies. Money flooded into dollar assets. It's a strange kind of irony. When the house catches fire, people rush to buy fire insurance from the house. But debt alone doesn't create wealth. Something else had to be happening. The American system shifted from savings-driven growth to credit-driven growth. Households borrowed to buy homes. Students borrowed for education. Corporations borrowed to expand, to acquire competitors, to buy back their own shares. The government borrowed to fund wars, tax cuts, stimulus programs. Credit became fuel. When you borrow, you are pulling future income into the present. You spend now, growth accelerates now, GDP rises now, the cost comes later. In many countries, this model breaks, borrow too much, and investors demand higher interest rates. The currency weakens, inflation surges, A crisis forces painful austerity. The United States rarely faces that constraint because its debt is denominated in dollars. And the Federal Reserve can create dollars. This doesn't mean there are no limits. It means the limits are different. Instead of default, the risk is inflation. Instead of sudden collapse, the risk is slow erosion. And for decades, inflation remained subdued. Globalization helped, cheap labor from China and other emerging markets kept. Consumer prices low, technology made production more efficient. Supply chains stretched across oceans. America could borrow, spend, and grow without obvious consequences. There is also the asset side of the equation, which is often ignored. Yes, the United States owes trillions, but Americans also own trillions in assets abroad: companies, stocks, intellectual property, foreign subsidiaries, and those assets often generate higher returns than what America pays on its debt. It's like borrowing at 3% and investing at 7%, that spread matters. US corporations are global. Apple, Microsoft, Google, Amazon, their revenues come from everywhere. The profits flow back to American shareholders. The stock market becomes a magnet for global capital. Foreign investors don't just buy government bonds, they buy US equities, real estate, venture capital. The American financial market is deep, liquid, transparent, at least relative to alternatives, if you manage a pension fund. In Norway or a sovereign wealth fund in the Middle East, there are only a few places large enough to absorb billions without breaking. The United States is the default option, so the country doesn't need high national savings in the traditional sense. It imports savings from the rest of the world. This is the hidden mechanism. Germany saves, China saves, oil exporters save. Those savings often end up financing American deficits. It sounds unstable, and maybe it is. But it has lasted decades. There's another layer, less visible but just as powerful. Innovation, debt used for consumption is one thing, debt used to build productive capacity is another. The US government funded the interstate highway system. It funded research through DARPA. It funded early semiconductor development. It funded the internet. Universities, backed by public money and private capital, became engines of research. Venture capital thrived in a culture comfortable with risk. Failure was not fatal. Bankruptcy laws were forgiving. Capital markets were flexible. So while the nation as a whole saved less, it allocated capital aggressively toward high-return sectors. The result was compounding at the technological frontier. Now compare the story people tell with the math underneath. The hype says America is reckless, addicted to debt, living beyond its means. The reality is more nuanced. It is living beyond its means in a narrow accounting sense. It runs fiscal deficits, it runs trade deficits, its household savings rate often dips below that of other advanced economies. But it also owns the currency everyone else needs. It controls key financial plumbing, it houses the world's most valuable companies, it absorbs global savings and recycles them through its capital markets. In effect, it monetizes trust in its institutions, trust in its legal system, trust in its military protection of trade routes. Trust that Treasury bonds will be paid. Trust is intangible, but it behaves like collateral. Of course, trust can erode. In recent years, the math has become less comfortable. Interest rates rose sharply after 2022 as inflation surged. Suddenly, servicing the federal debt became more expensive. Annual interest payments approached levels once reserved for defense spending. If rates stay high, the cost of rolling over trillions in debt compounds quickly. And geopolitics is shifting. Some countries talk openly about reducing dependence on the dollar. Alternatives to dollar settlement are being tested. Sanctions have reminded the world that dollar access can be political. None of this has dethroned the dollar yet, but the conversation exists. There's also a demographic reality. An aging population means higher entitlement spending and a smaller workforce relative to retirees, slower growth makes high debt ratios harder to manage. The system works as long as three conditions hold. The dollar remains dominant, US growth outpaces borrowing costs, global investors continue to believe. If those conditions weaken simultaneously, the adjustment could be painful. But here is the uncomfortable irony. The very deficits critics warn about are part of what supply the world with safe assets. US Treasury bonds are not just American liabilities, they are the backbone of global finance. Banks use them as collateral, central. Banks hold them as reserves. Financial contracts reference them as benchmarks, reduce deficits dramatically, and you shrink the supply of the world's preferred safe asset. It's not obvious what replaces it. So the world complains about American debt while quietly depending on it. That is the paradox. America got rich without saving because it built a system where other people's savings fund its spending. It transformed its currency into the world's reserve asset. It turned financial markets into global magnets. It paired debt with innovation and scale. It borrowed in its own language. It consumed in real goods. It paid interest in paper claims everyone else wanted. This is not magic, it is structure. But structures can shift. The question isn't whether debt matters, it does. The question is whether the unique advantages that allowed the United States to bend the rules can persist in a world that is more fragmented, more multipolar, more suspicious. For 40 years, America proved you could grow rich while saving less than your peers if you controlled the currency everyone else saved in. The next 40 years will test whether that privilege is permanent, or whether one day that quiet line in the ledger flips again and this time the world reacts.